Welcome to our wonderful panel. It's a great pleasure to be here. I'm very happy to be presenting our panelists who are joining us here today. First, from B3 in Brazil, I'd like to introduce their CRO, Marcelo. Marcelo, would you please come up to your seat? Next, hailing from London, we have David, the CRO of LCH. David, would you please join us too? And finally, the very local Dmitry Zenko from Eurex here in Frankfurt, their CRO. Dmitry, would you please join us? So it's a great pleasure to have the chance to moderate this panel, The Future of Risk Management. We'd like to thank, of course, the organizers and all of you for all the interesting conversations that we've seen across the last 2 days. I think they've saved the best for the last, of course, CCP risk management, the sexiest topic. It's wonderful that we have such great representation here from around the world. I hope that the panelists are able to share some of their insights concerning recent events, where they think that risk management for cleared markets will go in future. With apologies from Lee Betzel, the CRO of CME Group, he was unable to join us here today, which is very regrettable, but nonetheless, we have 3 stellar panelists, so I'm sure that we'll have plenty to talk about in a little while. I am told that you are encouraged to send questions. I have a tablet here which will display them. Towards the end of the panel, we will, of course, answer anything sensible that anyone has thought to deliver to us. The proposal for the panel, for my dear panelists, is that we discuss what has taken place recently. Following that, we thought that it would be a good idea to delve into sort of how CCPs interact with the changed ecosystem beyond the traditional default waterfall, member default type of risk management. And then thereafter, there's sort of an open part, which is about the future. So, to my panelists. I believe the first question, I mean, it's obviously been a couple of hectic weeks. I would say that since, for instance, the last forum, it's been a pretty intense year. For the markets that you're primarily active in, for the environment that you find yourself in, I mean, what do you think has happened? What's your take on recent events? Make that the last day, the last 2 weeks, the last year. Marcelo, would you like to start us off?
Yeah, sure. I'll start from maybe from the Brazilian perspective here. We've been pretty much ahead of the curve in Brazil where it comes to rates. In terms of impact of rates on liquidity and we've been seeing that in Brazil for a long time now. We weren't that affected by very recent events. Obviously, we felt volatility. But for the first time in many years, it was more volatility in treasuries than on DI futures, so on Brazilian interest rate futures. We still needed to manage that because we do accept offshore collateral, so we do have exposure to treasuries. We do have treasury futures, but still a lot less work. And we are our margin models tend to be less sensitive to volatility in general. So we didn't have to move initial margin a lot to basically adapt to the new events. We do carry a fair amount of idiosyncratic risk because of our because we are CCP for equity products, especially for stock loan and equity options. So we do carry a lot of idiosyncratic risks, and we saw some of those risks flare up. We had a big retail company in Brazil that went through an event, and so we had an 80% price variation on the day for that company, and you cannot manage idiosyncratic risks only with margin. you do need to do a lot of exposure management. Position limits are extremely important here. So this is something that we've been paying close attention to over the last few months.
Thank you very much. David, would you like to share any recent experiences?
Yeah, maybe I'll take it a bit broader and I'll focus on the rates market because that's most of what we clear in LCH. But in 2022, there was a real kind of paradigm shift in the interest rate environment from this very sort of low and static and constant world that we've been in for quite a few years to this world where suddenly rates were heading higher and more volatile and a lot more uncertainty in the world around central bank policy. You had meetings where 50 or even 75 basis points were on the table, whereas for the previous 3, 4, 5 years, it was 0, 0, maybe 25 at best, would be about the most exciting thing that happened. So the effect of all that on our markets, we saw quite a bit more volume as margin calls are suddenly getting quite a lot bigger, certainly in terms of VM. The initial margin models in our clearinghouse, they're designed to be dynamic models, so VAR HistSim-based models that will react as new information comes in. So both from a new scenario perspective and also from a vol scaling perspective, the models are meant to reflect current conditions in a kind of gradual way. And we put quite a lot of focus on analyzing this reaction function, as I would call it. And I think that there's a sort of Goldilocks effect that you're aiming for, reaction function that's not too hot, not too cold. The model notices something's happened, but it doesn't go crazy. That's what we're kind of aiming for. So that's what we saw happening in episodes through last year. I think the most significant thing for us clearing the UK was the mini budget that happened towards the end of the year. And I think although the UK public is kind of trying to forget that ever happened, maybe the model doesn't forget. It fades in the history, in the data set, and so the margin per unit risk has come back since then. But when that happened, you saw margins react at that time in quite a significant way.
Thank you very much. Dimitri, anything you'd care to share? Recent events? Has anything significant happened, or what's your take on everything that's been going on?
Yeah, maybe I started even longer ago, like 2020, it was similar, but in other asset classes. So we are Eurex Clearing, we are multi-asset CCP active in equity, listed derivatives, fixed income listed derivatives, OTC swaps, repo, FX, cash markets. So in a way, those crises that we observed over the last 3 years are similar but different. So in 2020, we had this volatility situation in equity markets. 2022, interest rate space. So we were observing kind of similar behavior. Also that David outlined on swaps and fixed income listed. More recently, last 2 weeks or so, again, volatility increased in rate space. And back to the logic of the CCP, CCPs are there to help market manage the risk, independent risk manager. When position change, when markets moves are changing, collateralization has to be fulfilled or restored shortly thereafter, after the market move has happened or new position was built up, or what else? Yeah, let's give it there. So we observed consistently through all this happening that, I mean, CCP and on our side, we worked according to this logic. Market move happens, we collect margin calls. So that's on the similarities. Same for equities back then, same for interest rate swaps last year and more recently now. What is different through these 3 cases that I outlined since 2020 is the industry discussions that are accompanying all this change. So at the beginning, it was maybe not so much understanding what are CCPs doing. Maybe some myths were out there that CCPs are, the source of the problem. Meanwhile, the discussion is more mature. It's understood that market moves are there, and CCPs have to restore collateralization. So it's back to the topics outlined also yesterday: market participants' preparedness, and then as a second point, how CCPs can help participants to prepare is by having transparent margins, so that we have a formula. As David, you have your formula. We tweak for it not to react too quickly, too slowly, but the formula is there. People can calculators are there. People can calculate to prepare for the effects. So industry discussion was very different at the beginning, let's say 2020, and now it's more mature and it's understood that dynamics of margin is a needed feature. Margin should react to changing markets. Otherwise, it's just the lack of capability to see and adapt to recent market conditions. So that I would compare, contrast, similar, but different along products and along industry discussions.
I'm somewhat amused that everyone had a much longer look-back period than I was asking the question for. But I mean, since we're going back to 2020 and speaking in terms of current events, sort of looking at that time window, I mean, is that an indication that there was some kind of phase change then and we're still in this kind of higher volatility environment? Or is it that, you don't think that is there something very different that's going on now than there was, for instance, in 2020? I mean, in your perspectives and how you're managing your markets, is it significantly different, like the mini budget event, or is it that there continue to be interesting events and there are just very many of them? For idiosyncratic topics or otherwise, I mean, is it as stressful, less stressful, more stressful?
I mean, for me, one of the most important things is being predictable and as a CCP and trying to no surprises effectively. So while we've been going through all of these events, procedurally, nothing has changed. So we still make our margin calls at the same time of day as ever. The data comes into the models react, the parameters get refreshed in response to changing liquidity conditions, haircuts get refreshed in response to changing bond markets. So I think the quantum and maybe the visibility of some of the things that we've done and decisions that we've taken has maybe gone up as these type of events get more or have been more frequent in recent years. But we've not really changed anything in terms of what we do.
Yeah, I think Dave has a good point here. We haven't changed in terms of consistency of processes and predictability, and I think this is very important for our participants' management of their liquidity, which obviously in the end could also come back and come back to us. So I think this is a very good point. I think even though we've been through maybe more extreme events recently than over I don't know the past 10 years, 2020 back 10 years. We've kept the predictability and the processes, and I think that's very important for the participant, and it's very important for the CCP.
Dimitri, do you have a different take, or is it similar to what we hear from David and Marcelo?
No, I would agree. It's within the same processes, within the same parameters in a way. For sure, if now that we observed in 2020 strong market moves, we included this in our stress periods, and historical stress tests were updated. Similarly, also the interest rates moves, but that's still within the parameters and within the whole framework. No strong adaptations were needed.
Well, then going beyond the margin model, I mean, if I'm understanding you correctly, you'd say that sort of the operations of the CCP are the same, but if things are more volatile, more stressful, or if you have more idiosyncratic events, I mean, are you finding that you're doing other portions of your broad risk management differently? I mean, are you monitoring your members differently? Are you instituting different kinds of trade entry rules? I mean, in these sort of trying times, are you seeing that your participants are trading differently in ways that you feel that you should adapt to, or are they behaving as they did before, but we just live in a more volatile environment?
Well, yeah, I can take this one. I don't think participants are, at least on our markets, behaving differently. I think volumes are up, and they've been up from 2020 onwards. So this is a reality. We've had more volumes, more risk. I mean, we went from close to $50 billion in risk to almost $100 billion in risk over the past years in Brazil.
So do you mean in terms of initial margin?
In terms of initial margins,
right.
Yeah, exactly. Definitely we have more risk, but I think it's just a reflection of having more volume on the market. I think in terms of procedures, we haven't had, I think, new procedures. But obviously, again, for us, it's always been, we do carry idiosyncratic risk, so closely monitoring and guaranteeing that we have the right exposure size for the right size of clients has always been an important thing. We do have, we do have a difference in Brazil is that we are an end client market, so we calculate risk and we monitor at the end client level. This tends to help in those times because we are maybe quicker to spot exposures. But I wouldn't say we've done something different. It's just we've had more volume, and we are carrying more risk at the CCP. And obviously the whole process is built up in such a way that once the amount of risk that you carry increases, the safeguard structures increase with it. So you have to guarantee that this is working properly, I think.
So this sort of, you're just recalibrating to essentially your participants doing more risk transfer through the CCP,
Yeah,
but
exactly.
you haven't found, and is that similar for the two of you too? I mean, do you find yourself working longer hours, or it's more relaxing, more vacation these days?
No, we're working pretty hard at the moment. Last few weeks has been quite busy, but I would maybe add on the member user behavior side. We have seen in quite a pronounced way quite active liquidity management in terms of the clearing accounts. And where we've seen these deleveraging episodes, it's tended to be much more driven by VM than IM. But what we see members doing is the more sophisticated ones are hooked in directly to the clearing analytics through API type approach. And when you go through a period of relative calm for several weeks and into months, we see the clearing accounts tending to get managed in a very efficient way with buffers coming down and optimizing around different rates of return on different currencies of collateral and that type of thing. So things become quite, focuses more on efficiency. And then what you see is when you move into more of a volatile type of phase of the market, just having buffering and liquidity reserves in the account becomes the primary objective for a lot of users. So we suddenly see the buffers in the system pop up, and the optimization piece kind of takes a back seat for a while until things calm down again. So that's the sort of behavior that we see.
So market participants have gone cleared for a large portion of the risk, and things are more volatile, but they're also more attuned to managing the initial margin. But sorry, maybe I misunderstood.
That dynamic's always been there.
Right.
But it's just you see it in markets where you're transitioning from volatile to calm. That's when you had the chance to sort of observe it in a bit more of a clear way.
And you mentioned variation margin. I mean, do you find that participants are prepared differently for variation margin calls than maybe they were in 2020? I mean, there were myriad conversations of how liquidity preparedness went down through the chain to the end users. I mean, do you find that there's a different approach, or are things more or less the same?
I wouldn't say things have totally changed night and day, but I'd say there's more, the analytics is better and there's more awareness, and every time you go through one of these type of episodes, it builds experience and the memory is more recent. So I think people are more on their game as of right now than they were maybe 3 years ago. In a very generalized way.
Yeah, I think we have the benefit of having gone through 2020, right? Because then at that point we were almost 10 years without a huge shock. We had Europe in 2012, 2015, but not really a huge shock. So once you went through 2020, I think people understood what that means in terms of liquidity management and how you should be prepared. So I do think that members are more prepared now than before 2020.
Dimitri, any comments to the question also? I mean, is it a similar experience on your side, or?
Yeah, on member behavior, just to state the obvious, we had no member defaults. So in a way, even though margin calls were needed due to market moves and volatility increases, margin calls were fulfilled. So that's unchanged behavior, at least from our side, what we observed. Changes in a way, as I said, this industry discussion, how the members accompanied. Starting 2020 was big surprise since long time. So, but we had discussions, we had more, events where we explained how it works. More push from members to understand margins, to calculate margins. We said we have calculators in place and other people are using that. So a lot of interest there over time. And now I think that we have now third wave, so to say, of a volatility spike. I think people are more prepared and understand how this all works. So it's back to now polishing, and can we do some incremental improvements? Let's engage in talks, not to change, right now, but how can we all together improve the processes along the process is proven, but incremental improvements always make sense to think about. And the third one, trading behaviors. Yes, if we observe these big spikes, big changes in in the situation, in the news, then we observe a lot of trading volumes. So just recently, 2 weeks ago, we had quite strong trading volumes. So that is visible. So repositioning was happening. Not so much. Not so much in terms of, it didn't lead to increase of initial margins overall, but some repositioning was there, so end risk is roughly similar than before, so few observations.
So, I mean, maybe Dimitri then, to change tack a little bit and ask you first, I mean, for all this operational complexity, I mean, in terms of the CCP, its participants, with the sort of clearing members and their clients and the vendors and the entire sort of ecosystem that supports these now much larger volumes and greater volatility. I mean, from an operational perspective, I mean, do you think that the risk management that you have to undertake has changed, or is it the same as it was 10 years ago, 5 years ago? I mean, do you think that there's a greater complexity, or maybe there's a simplification? Maybe technology has made your life easier. Maybe it's easier for your members to, for instance, pre-plan for these events? Or do you think that the threats that sort of come for operational risk are different now?
No, operational risk topic definitely gained on traction since few years already. Also, information security part, cyber topics picked up. They are not so visible in the CCP regulatory agenda. Regulatory agenda was mainly targeted at waterfall. What are the resources in margin? What are the stress testing, default fund, and recovery resolution? What happens if waterfall is not sufficient? Or so only on this default and financial side. Less so on non-default losses. So that was the angle from the CCP regulation on operational matters. But now it's more and more relevant, and it's got more relevant from the ION incident just recently. So that was, I mean, everyone was taking care about information security, processes to get protected, but it maybe was a bit theoretical exercise for many. Now it's a practical practical issue, very visible, and I think this can be a catalyst for industry, for regulators to work together. In terms of risk management, it's other type of risk management is needed there. So first, yes, you need to prevent these things from happening by having state-of-the-art processes to do your vulnerability management, your asset inventory, what safeguards you need. Yes, you can calculate, and you should calculate what are the scenarios, how much would it cost, but that's for me, and it shows the results are showing it's only a byproduct. These numbers, the real outcome of this exercise is to strengthen the process, to introduce safeguards that so that these big numbers don't happen. And by the way, in this specific case, ION or many similar cases, capital doesn't help. So coming to the second part of risk management, you have to prevent in first place, but you have to assume that these things happen, and then you need to have invested in resiliency, in redundancies, and in backups, so that you can recover quickly. So not only risk manage, but also have strong, in a way, issue management or recovery. So other angle of risk management, not calculating margins, financial resources, but all about processes, safeguards, and recovery.
It's quite interesting to hear you say that the expected loss is sort of a byproduct of attempting to...
They help you to prioritize where to look first. If you go through your processes and you say what can go wrong, you have a scenario which goes into big numbers, and you say, okay, then I want to prevent this scenario from happening by installing some safeguards in this part of the process. So they help you to prioritize, but they are not, self-purpose.
It doesn't help you manage the risk.
Yep. So same risk management cycle applied to your process.
So, for the others too, is that sort of your take on NDLs? Is it more a preventative one, or do you sort of consider how to recover from it, or are you interested in calculating what might be the loss for some part of the market for yourselves if one of these NDLs sort of occurs?
Yeah, well, we've been, so I think a large part about running a CCP is having contingencies for as much scenarios as you can think of. And with non-default losses, I think it's a similar take. You do want to make sure you have your contingencies and that you as a CCP know how to deal with the contingencies, and also you're ready to support your participants in dealing with the contingencies. It might be just, have a file for something that the participant does with messaging or automatically, so I think the big focus here is, as Dimitri put it, is being able to deal with the contingencies, and I agree that calculating the size of the contingencies is a good way of prioritizing where you should have resources. So yeah, I agree that NDL, a big part of NDL management is putting the correct amount of resources in where your largest risks are. A little bit like default losses as well, right? You want to have the correct amount of resources to deal with default losses. For NDL is more or less the same thing.
I don't have a lot to add to what these guys have said. You've got it covered.
Since Dimitri, since you mentioned a sort of incident, a vendor, do you find that the third parties, the vendors, the sort of other participants that are part of making clearing happen are something that you're paying more attention to, or was this always something that you sort of had as part of your remit as CROs? Have something changed? Was it this particular event, or is it just that there's a modification in how participants are technologically connected into the clearing system?
I don't think it's just the ION thing. I think it's the regulator spotlight has swung onto this and is shining quite brightly as a thing for us to focus on. And I think I would say it's the same applies to this as a risk in the sense that it's possible to generate quite a lot of paperwork around diligence of your third and fourth parties and maybe convince yourself that constitutes risk management. But what you get much more value out of the genuine actual activities that you do around this, and they need to ideally be done jointly with those important third parties. So planning of joint contingencies where you have incidents going into an incident review and lessons learned jointly together, and doing crisis management testing jointly with your important third parties. These type of things really add quite a lot of value in terms of really managing the risk.
Any thoughts from the others, or is it a similar approach? And thank you, David.
No, I think it's a similar approach, yeah.
I mean, for another topic, of course, which the regulators are sort of very keen to discuss, as I'm sure we all are. I mean, for cyber risk, I mean, do you feel that this has changed? Is it that there's a different level of interconnection? Is there a different level of malicious actors? Are your systems different?
I think it has changed also, I mean, for many reasons. Just to name two, during Corona, everyone started working from home, or many people, so via virtual connections, and it's more prone for attacks. Second one, war in Ukraine, more activity, and we saw examples in other industries as well that companies were hacked, ransomware. So it's definitely on the threat landscape and on observed cases elsewhere, it's growing, and that's so that's there. Regulators definitely pay attention to that, but they paid attention to that also before. And there is a bigger theme behind all that. So this thing of technology, and it produces a lot of efficiencies, but it has also downsides. You are kind of over-reliant on this thing. And we are coming to similar considerations when we try to manage this. It's similar considerations that we heard in yesterday's panel. Over-reliance on one something, concentrations with something is bad. So you should maybe have two things. That's the way to manage. So in a way, same theme is happening with a technology where we achieved a lot. I mean, we all as an industry, and now maybe it's the next wave to make it a bit more robust. So and those events that were happening now, ION, cyber increase, just help us to sharpen our attention and work together to make this a better place.
And I think as participants look more and more for efficiencies, you tend to get more actors than you had before. So there are more moving parts. There are more intermediaries in terms of technology. So I think, we have, if you look as opposed to what we had maybe 10, 15 years ago, we have a more complex environment where people are connecting to us and we're connecting to people through more actors than we had before.
Yeah, I would say Dimitri is correct. I think the threat level is as high as it's ever been right now, for sure. But I think on the positive side, the level of sustained investment that any responsible firm has done over the last several years means that the kind of defense side of the equation is also stronger than it's ever been, and the level of coordination that we see between market participants is actually pretty good. So I feel, although the inherent risk is pretty high and out there, the level of preparedness is quite good actually from what I see.
As a sort of testing question on that point, I mean, have there been, to your knowledge, successful penetrations, cyber attacks, or other NDL-type incidents that affected, for instance, your CCPs? I mean, is it common? Does it ever happen? Does it never happen? If there's anything you're able to share, of course, that would be very interesting, I think.
Yeah,
I think these things are, I mean, very secretive. So if you are into this industry, it's interesting industry. So it's, but I can tell you that's part of the information security programs to have this, ethical hackers trying to find holes and then to enable company to close the holes before real hackers find it. So in a way, there is a lot going on there to to prevent bad things from happening.
Yeah, I think we have enough detection to know that if we didn't have any defenses, we would have been hacked quite a lot of times by now.
yeah, I think that's pretty much a reality, right? It is a reality of the world that we need to have detection, and we need to have the correct protections against this, because it's out there.
And I mean, if we try to look ahead in the future, I mean, do you think that, for instance, next year around this time, we'll be discussing this more? I mean, you talked about these sort of preventative capabilities, sustained investments, making sure that you have ways of restarting things if something does break. I mean, do you think that this will be a larger and larger role of your lives as CROs, or?
I mean, it would constitute success for me if we could stop talking about this. That the battle was won, and it became a boring process that happened in the background but didn't generate anything of interest. That would be winning.
Yeah, I think I'm less optimistic here.
I'm not saying we'll get there.
I think cyber will be on the agenda, and I think issues related with not related with defaults will still be on the agenda.
But I think it's not specific to CCPs in a way.
Yeah.
It will.
Yeah, but it's not. Yeah, you're right.
So and my kind of optimism in myself tells maybe there will be some industry practice invented that it's like, when kids play with the plug with the electricity, there is a plug, and then it's solved forever that they cannot put their fingers into this plug. So maybe something like this will be invented, and then it's solved. But yeah, let's see. For until then, we will have it with us, not only we, everyone.
Very well. We have received a few questions. I'm sure you'll be delighted to hear them. But before we get to them, just looking ahead, I mean, for everything that's taken place, let's say since 2020, I mean, and for where we expect to go from here, maybe we'll have the pleasure to be re-invited in for the next forum. Is there something that you kind of consider to have surprised you, something that ought not to have happened? It doesn't have to be specific to your markets, but I mean, as a sort of something that you take from recent events that will inform your thinking going forward, or do you just have a prognosis for where things might go from here? I mean, do you think that you will start to work or act differently as CCPs, that your participants might trade or risk manage differently? I mean, any thoughts for where things go from here?
No, not really. In terms of changing things, but I think we'll keep on investing in pre-trade risk management. I think that's for us at least, that's a very important point in terms of managing, as I said, managing exposures, is to get risk management as close to the moment where the bid and the offer become a trade. We have a big listed derivatives and equities market, and we do become CCP once the trade comes in. So I think for us at least, to continue investing in getting risk management, getting risk calculation as close as possible to the moment when the trade comes in is very important, and will continue to be. Preventing the problem before it becomes a problem, I think, is at least for our listed markets is very important. And it's I think we've learned from the past that this works. when you can bring credit risk into pre-trade risk management, and manage not only liquidity risk but also credit risk before or while the trade is coming in, that this makes a big difference. So I think this is definitely something will want to continue investing on.
David, any thoughts?
Yeah, I think on our side, one thing that we're putting quite a lot of focus into is a sort of next generation data strategy around risk information, and recent events sort of brought this into quite sharp relief in terms of a live example with what happened with Silicon Valley Bank. So at that stage, this kind of issue of bank hold to maturity bond portfolios and unrealized losses had a kind of very high level of focus quite quickly, and that wasn't information that we would easily have at our fingertips in an aggregated way and be able to sort of cross-reference it with our membership data, exposures, margin, clearing balances, that type of thing. So it's a bit of work to pull that information together, but in a future state, you would have much more of a kind of intelligently AI searchable type of database to give you, that type of information and a whole bunch of other stuff. So that's one of the things that we're sort of thinking about in terms of more of a kind of blue sky project.
Very interesting. Also sounds sort of less passive, more proactive, trying to have sort of a intelligent overview of these things before they...
Yeah, I mean, it has to be quite a big database to cover any and all eventualities, but the idea is there.
And Dimitri, any parting thoughts for where we go from here before we try to answer a couple of questions?
Yeah, so thoughts for the future. So coming back from the angle of what is the value proposition, so multi-asset CCP, independent risk manager for the markets and participants in markets, we want to make it even better. So there will be changes, but that's the frame. For example, if we are talking about transparency, that's not for the sake of transparency itself, but for the consumers of the transparency, so our members and clients, to make their processes better fit with our process to help industry, risk manage. So that's one angle. Another angle, transparency, and now coming closer to what maybe a regulatory agenda is looking or will be or should be looking, is we saw a few events that we haven't mentioned, but let's say LME Archegos. It's also about lack of transparency in uncleared space. So that, or at least uncleared, is part of the contributing to the issue. So if we want to be as an industry, to achieve systemic stability, yes, we need to have transparency in cleared, but it needs to be combined with transparency in uncleared. I'm not saying it's us, maybe it's regulators, and then kind of strong approaches in risk management can be applied. So that I think more can be done, will be done, my expectation.
Very well. Well, thank you all. Just for pure transparency, we're getting so many questions that I can't see them all. Maybe I'm not using the tablet correctly. One of them is about specific indexes for prognosis. What do you think the value is going to be in this year? I won't ask you this question, but I am amused that somebody wanted to gain this information. Perhaps you do all know. There were sort of questions which I'll try to break up into little pieces very briefly, and I'd only ask one of you to answer. If you all want to, then please shout, but make it brief. Somebody said that there were an increase in the number of exceptions, so situations where margin parameters are not covering the full market move. They didn't specify which asset class, but this was 2022. And the question was, if there's an increase in those kinds of events, these exceptions, does that mean that your margin models are not reacting appropriately? So question, I don't know if one of you wants to take that, or if you feel that you had an increase in breaches, and this was either desired behavior, expected behavior, or deeply uncomfortable and to be changed.
I mean, I'm happy to take that one because we have reported exceptions in some of our services. So for me, when you look at events like the mini budget, which had moves that were the biggest in the effectively the all-time data set, so kind of 30 plus years, I would want that to be outside the envelope of my initial margin calculation. And the alternative really is that you have extremely high levels of margin at all times, which is not really a very efficient way to run the financial system. So when you look at these metrics for, they tend to be on an 18-month look back as well, the published, or something of that order, the published statistics, you can see this dropping below 99.7 or whatever your sort of risk appetite threshold is. And for me, that's a indicator that you need to, it's an indicator on your sort of dashboard of is my model performing, but it doesn't tell me prima facie that my model is broken or needs changing. What it tells me is something quite big has happened in the market that the model did not imagine or had no reason to know that could happen. So if you then dig into that, analyze it, understand it, and you see that the model has reacted and is now charging something more appropriate based on what it has learned, that sort of bad statistic is still with you through time. But provided the model is now, or has learned and is doing what you want it to be doing, then for me that indicates good performance.
I see red zeros on our timer. I apologize for those that did send in other questions, and perhaps I haven't seen the most interesting ones, but thank you all very much for sharing your thoughts today. I found it very interesting. I suppose that we just walk off stage now, or is there something else that we ought to do? No confetti.
Thank you very much on
Thank
my
you all
behalf
very
as
much. I
well.
hope you have a wonderful stay.